Hello friends, welcome to the Book Summaries YouTube channel. Have you ever wondered why, even though crores of rupees are traded in the stock market every day, only a few people actually make money from daily trading? Most people either give up or keep facing losses. But why does this happen? This is the central question of Ashwani Gujral's book, How to Make Money in Intraday Trading. In this book, the author shares his years of trading experience in very simple language, so that even a common person can understand how to earn money daily through trading. According to the author, trading is an art that can be learned if you adopt the right mindset, rules, and strategy. He first explains that the real enemies of a trader are greed, fear, and hope. When a trader is trapped in these emotions, they start making wrong decisions. A successful trader is someone who can control these emotions and make decisions based purely on facts and data. Ashwani Gujral highlights that most people lose money because they trade without any plan. They jump into the market based on others' opinions without any strategy. The author emphasizes that trading is not gambling. It is a profession that must be approached with full preparation. One of the most important takeaways from this book is the concept of a trading system, a system that tells you when to buy, when to sell, and when to exit. A good trading system is one that has been tested repeatedly and is backed by data. The author says that discipline is the most powerful tool in any trading system. No matter what system you follow, if you are not consistent, you will not succeed. He also explains which charts and timeframes are most useful for intraday trading. For example, the 15-minute chart provides excellent signals. In addition, he gives a simple introduction to technical tools like moving averages, support and resistance, and volume analysis so that even beginners can understand how to use these indicators for entry and exit decisions. A special lesson from the book is to treat every trade like a business decision. Before entering any trade, you must ask yourself, if the trade goes wrong, how much loss can I bear? And if it goes right, how much profit can I make? This mindset helps you mature as a trader. The author also teaches how to manage your trading capital wisely. Putting all your money into a single trade is the biggest mistake. Instead, divide your capital and risk only a small percentage per trade. That way, even if one trade goes wrong, you can still survive in the market. Ashwani Gujral shares some of his personal experiences, how he faced big losses in the beginning, then created a system, tested it, and stuck to it with discipline. Eventually, this led him to success. He says you should trust your system, but not blindly. You must understand every part of it thoroughly. Another important idea from the book is that the market always gives opportunities, but only to those who are prepared. If you're not prepared, you'll miss even the best chances. That's why the author repeatedly emphasizes practice and preparation. Time plays a huge role in intraday trading. According to him, you can get an idea of the market direction in the first 15 minutes of the trading day. And based on that, you can plan your strategy. Also, it's not necessary to sit in front of the screen all day. There are specific times when the best opportunities come. If you can identify them, you can make good profits in less time. His message is clear. If you think you can earn money through luck without working hard or learning, then you are wrong. The market rewards the experienced and punishes the half-knowledgeable. So, where should someone start after reading this book? The author answers this too. First, prepare your mindset. Second, choose a system. Third, test that system repeatedly. And finally, trust it and trade with discipline. He shares practical setups like breakout trading, range trading, and trend following, explaining in detail how to identify and use them. Many people believe that technical knowledge is enough in intraday trading, but in reality, mental strength is even more important. Until your thinking is strong, you won't be able to stick to any strategy. Imagine taking a good trade, but the market briefly goes against you, so you panic and exit. Later, it moves in your direction, and you miss the profit. This wasn't the system's fault, it was your mindset. This is the key difference between a losing trader and a winning one. Successful traders don't feel the need to trade every single day. They only take trades when a clear opportunity arises. They stay calm, control their emotions, and never make hasty decisions. They think, there will be another chance tomorrow, there's no need to force a trade today. Before every trade, ask yourself 3 questions. Do I understand this trade? Do I have a plan for it? If it goes wrong, how much loss can I bear? Only. If you honestly answer yes to all 3, then take the trade. Otherwise, just watch. To maintain discipline, keep a trading journal. Write down every trade. When you entered, why, on what signal, what was your risk, and what was the outcome. Over time, you'll start seeing your own mistakes, and you'll grow from them. Controlling emotions is the hardest part of this journey, especially when you face 2 or 3 back-to-back losses. You feel like quitting or taking big risks to recover losses. But that's the moment where either a good trader is born or a quitter. There are many signals in the market, but you don't need to trade every signal. A good trader knows which signals are strong and acts only on those. You don't need 5 or 10 trades every day. Even 1 or 2 good trades, if executed properly, are enough. Another key lesson: stick to one strategy again and again. If you keep changing strategies, you'll never master any. Pick one system, understand it deeply, practice it thoroughly, and master it. That's the road to success. When you look at charts, the first thing to identify is the trend. Is the market going up, down, or sideways? Next, find support and resistance levels. Then analyze the volume. If volume is increasing in the same direction as price, it's a good signal. Time frame also matters. For intraday, 15-minute and 30-minute charts work well. They help you find better entries and exits. Also, understand when the market is most active. Generally, 9:45 a.m. to 11 a.m. and 2 p.m. to 3:30 p.m. are considered the most effective trading hours. I always set a stop loss before every trade and stick to it no matter what. If you've decided to exit below a certain level, then exit no matter what you feel. Many traders stay in losing trades, hoping the price will come back up, and that hope destroys them. Position sizing, deciding how much to risk per trade, is another sign of a skilled trader. If your capital is 1 lakh, then risking 10,000, 15,000 per trade is enough. This way your losses stay limited and you survive longer. Never take a trade just because someone else says so. Especially when you hear stock names on social media or Telegram channels, don't get greedy. Check the chart yourself, analyze the position, and then decide. The real meaning of learning is the ability to make your own decisions. Many times, the market gives fake movements called noise. A good trader can identify and avoid this noise. They only trade when signals are clear and sit silently at other times. That silence is their strength. Intraday trading demands quick, decision-making ability. But that decision should not come from haste. It should come from experience and practice. When you see the same pattern repeatedly, your eyes begin to recognize it. Your mind starts making decisions without panic. This is called trading intuition. After trading every day, analyze your entire day. What did you do right? What went wrong? And what did you learn? This daily review helps you improve. Over time, you'll notice your mistakes reducing and correct decisions increasing on their own. It's good to feel inspired by others' success, but comparing yourself with them is wrong. Everyone's journey is different. Everyone's experience is different. Your success depends on your patience and your learning speed. So focus only on your own progress. Now let's talk about some practical examples that will give you a clear mindset and a solid plan before you step into the real field of intraday trading. Suppose you see a stock that has been rising continuously over the past few days. But today, suddenly, it gives a gap-down opening. That means the market has developed negative sentiment about the stock. Overnight, you start observing it carefully on the chart. Around 9:45 a.m., You notice that the stock slides downward for a while, but then forms a strong candle and starts rising again. This is the first sign that perhaps the earlier fall was just an emotional reaction, and now the stock is returning to its original direction. Then you check the volume and see that the rising candle has high volume. This is the second confirmation. Now you look at the previous support level on the chart and decide that if the stock goes below that level, your analysis may be wrong, so you set your stop loss there. Then you take entry as the stock gives another upward breakout. This is a classic pullback breakout setup, which is considered very reliable in intraday trading. But one important point here is, when you see such a setup, don't rush. First check what the broader market like Nifty or Bank Nifty is doing. If they are also moving in the same direction, the strength of your trade increases. Otherwise, your stock may become weak in isolation. Now let's talk about another strategy called opening range breakout. This strategy works when the first 30 minutes of market movement is very clear. That is, from 9:15 to 9:45 a.m., the stock moves within a range and then breaks out of that range. If the breakout is upward and volume supports it, then it's a signal that buying interest is entering the stock. But it's important to ensure the breakout is not fake, meaning after the breakout, the stock shouldn't fall back into the same range. That's why you must set your stop loss in advance. As you practice these strategies, you gradually start understanding when the market is deceiving you and when there's a genuine opportunity. With this experience, you start building confidence. In your trading, many times the market becomes very quiet, meaning volatility is extremely low. In such cases, most new traders get restless and take random trades. But that is the biggest mistake. When the market is calm, the best decision is to do nothing. Because in low volatility markets, the chances of fake breakouts are much higher. Stock might go up briefly, then down, then up again, and fall back, basically getting stuck in one place. In such cases, stop losses keep getting hit, and fear starts building in your mind. On the other hand, when volatility increases and the movement is clear, that's when a mature trader takes entry. They know that their strategy will only work if the market supports it. Now let's talk about confidence in trading. Confidence doesn't come suddenly, it comes from experience. By making the right decisions repeatedly and learning from the results. When you accept your mistakes and learn from them, only then can you grow. Never think that you will win every trade. That's impossible. Even professional traders go wrong many times. But their success lies in keeping losses small and letting profits grow. So always remember, losses are a part of trading. But reacting to those losses by changing your system, chasing your losses, or doubting your own strategy, these are all signs of a losing trader. Your real test happens when you face 2 or 3 consecutive wrong trades. Can you still stay calm? Can you still trust your system? This is the difference between a professional and an emotional trader. Now let's talk about breakout failures, also called fake breakouts. When a stock moves out of a range and you think it's a breakout, but it quickly comes back into that same range, that's called a fake breakout. To understand this better, first, you need to observe how the volume behaves during a breakout. If there is no volume, then the breakout is not reliable. Also, you must check whether the broader market is supporting that breakout. If a stock breaks out on its own, but the index or sector is moving against it, then that breakout is less likely to sustain. That's why, before every entry, it's crucial to notice these small signals. As you start understanding these elements, your trading accuracy improves. You begin to make decisions without panic. Even if a trade goes wrong, you don't get stuck in it. This kind of mindset and behavior is what leads to success. So far, you've learned how to identify a good setup, how to consider timing and volume, and how to control emotions. Now let's talk about position management, which means once you've entered a trade at the right time, the question is, how long should you stay in it and when should you exit? Most beginners enter trades without knowing when to exit. Let's say you bought a stock at 200 and it quickly rose to 210. You're happy, but then it drops back to 204. Now you're confused. Should you sell or wait? If you haven't pre-decided your profit target, this confusion can lead to losses. That's why, with every trade, you should have a clear target and a trailing stop loss. Trailing stop loss means as the stock price increases, your stop loss also moves up. This limits your loss while maximizing your gain. For example, you buy a stock at 200 and set your stop loss at 197. When it goes up to 205, move your stop loss to 202. At 210, shift it to 207. This way, even if the stock drops, suddenly, you lock in some profits. Now, let's talk about scaling in. Scaling out. This means buying or selling in parts instead of all at once. Suppose you think a stock might go up, but don't want to invest all your money at once. You buy a small quantity first. If the price goes in your favor, you add more. This is scaling in. And as the price rises, you gradually book profits. This is scaling out. The benefit? You don't put all your money at risk at one price point. You take decisions step by step with the market. Another very important habit in trading is journaling, keeping a record of every trade. When did you enter? Why? What was your stop loss? What was the result? By reviewing your trades over time, you start to identify patterns in your mistakes. Most of the time, you'll find the same errors repeating, and that's where you can improve. Now let's talk about one of the biggest enemies in trading. Overtrading. When you trade too often without a solid reason, just because you fear missing out, you end up losing. A successful trader waits patiently, like a hunter waiting for the right moment. They don't chase every opportunity. A smart trader may only take 1 or 2 good trades in a day. Now let's shift our focus to the mental state of a trader. When you make consistent profits, greed starts to build. You start taking more risks, thinking you can make more. Then one bad trade wipes out your entire week's profit. This greed pushes you into overtrading, creating a cycle that's hard to escape. That's why, before every trade, ask yourself, is this trade based on my system or my emotions? If the answer is emotions, don't take the trade. Next, let's understand the language of the market. A stock's movement is not just a number, it tells a story. If you learn to read that story, you can guess the next chapter. You need to pay attention to charts and price action. Every candle tells you something. You just need the patience to listen. Always remember, the market is like a battlefield. Someone wins and someone loses in every trade. If you enter this battlefield without preparation, you're bound to lose. That's why having a strong strategy is essential, with clear rules. When to enter, where to place the stop loss, when to book profits, and most importantly, when to do nothing. Sometimes, the market gives no clear signals. In such times, doing nothing is the wisest choice, because without a proper signal, every trade is a gamble. And always remember, trading is not a get-rich-quick scheme. It's a profession, just like any other, and it requires practice, time, discipline, and patience. Trading psychology is the biggest reason behind either success or failure. Many people learn the technicals, but when real money is on the line, their mind starts to shake. Fear, anxiety, greed, hope, all these emotions turn good decisions into bad ones. For example, when a stock falls, fear forces us to sell early, even if it hasn't hit our stop loss. When it rises quickly, we hold it too long hoping for more, and miss the chance to book profit, only to see it fall again. There's only one solution to this: discipline. Before every trade, make a plan and stick to it no matter what your emotions say. There's another mental trap called revenge trading, when you face a loss and immediately take another trade just to recover it. You don't have a plan. You just want to win back the money. But this only leads to more losses. A smart trader accepts the loss, writes it down, and returns the next day with a fresh mindset. They don't take losses personally, they treat them as part of the system. Another trap is FOMO, fear of missing out. When the market is rising and everyone is making money, you feel you'll miss out and take a trade without thinking. FOMO causes the biggest losses. That's why every morning start with a calm mind. Ask yourself, do I see a strong setup today? If not, don't trade. Now let's talk about the daily routine of a successful trader. They wake up early, look at charts, check the news and global markets. Then they decide what could happen that day. They have a clear trading plan and stick to it. After trading hours, they analyze every trade. Where did they go wrong? What was done right? And how can they improve next time? These habits are what turn an average trader into a professional. Now, let's discuss backtesting. This means testing your system on past data. Many people use a system without testing it properly, and when it fails, they blame the system. Backtesting shows you where your system works and where it doesn't. It builds confidence and keeps you steady while trading. And finally, remember this: trading success doesn't come from knowledge alone. It comes from consistent practice. Look at charts daily. Trade with thoughtfulness. Learn from every mistake. Every trade is a teacher. Every day is a classroom. If you keep learning, you'll keep growing. Trading is a mental game, and your biggest enemy is yourself. If you can learn to control your emotions, the market will offer you opportunities every day. Remember, making money isn't hard. What's hard is controlling your mind. But once you master your mind, conquering the market becomes easy. Your goal should be to become a trader who doesn't fear losses, doesn't get overexcited with wins, and approaches the market every day with a fresh, thoughtful perspective. If you truly absorb all this, you too can become one of those few successful intraday traders who make money from the markets daily. With discipline, patience, and wisdom. So friends, intraday trading is not magic. It's an art, a science, and most of all, a mental battle. The market plays a new game every day, but a disciplined, well-prepared trader is always ready to face it. If you only chase money, you may lose your path. But if you chase learning and discipline, then money will eventually chase you. The one who survives in this game is the one who never stops learning, who knows how to get up after every fall, and who sees every loss as a lesson. Trading success isn't easy, but it's not impossible. If you're patient, confident, and practice consistently, you too can reach the level where every day, the market becomes an opportunity for you. True victory is not just in earning money, it's in winning over yourself. So now, it's time to let go of fear, learn from your mistakes, and start walking on the path that can turn you into a successful trader. The market is waiting for you. Are you ready? If you enjoyed this summary and learned something new, do like the video. And if you don't want to miss such powerful and useful content, then subscribe to Book Summaries and hit the bell icon. Now, one question for you. Have you ever taken a trade purely based on emotions without a plan? What did you learn from it? Do share your experience in the comments so that others can learn too. We'll meet in the next video with a new book, a new lesson, and a new perspective. Thank you.